For decades, the world's largest institutional investors have funneled trillions into private equity and private credit, while most individual investors were left out in the proverbial cold. High minimums and the lack of liquidity made simplified access nearly impossible. The good news is that the tide is changing. In recent years, the development of new and innovative structures offer unique access to previously inaccessible opportunities. It's also making the job of advisors much easier as they seek to differentiate their offerings and add less correlated investments to their clients' portfolios. In this video, we will answer the following questions. Why private equity? Why private credit? And how adding private investments to traditional portfolios may reduce risk and increase overall performance. Let's start with private equity. Between 1986 and 2023, global private equity as an asset class produced average annual returns of 15.7%, while the global stock market produced 9%. As an example, if you invested $1 million in the global stock market in 1990, by the end of 2028, your investment would have grown to over $28 million. Contrast this with $1 million invested in private equity, which would have grown to an astounding $293 million. That is the power of compounding in action. Naturally, this outperformance has caused the deepest pockets, so endowments, sovereign wealth funds, and the ultra-high net worth, to flock to the best performing managers. Another key driver for private equity is that fewer companies are going public. The number of publicly traded U.S. companies has fallen nearly in half, from over 8,000 in 1996 to less than 3,800 today. When you look at the business landscape in the U.S., approximately 87% of companies with over $100 million in annual revenue remain privately held. There are tens of thousands of companies that meet this threshold. This represents an ocean of opportunity for strategic capital investment. For investors and the advisors that represent them, private equity as a complement to public equities may seem like a no-brainer. However, accessing top-tier managers with proven track records becomes a challenging feat, as most funds are limited in size and thus become oversubscribed quite quickly. Access, buying power, and relationships become an integral part of the game, which we will discuss ahead. For now, let's move on to private credit. For investors seeking steady income, private credit has outperformed bonds quite handily. For the 15-year period ending in 2024, global private credit has returned 9.5% annually, while global bonds have returned 2%. This outstanding performance has resulted in a huge influx of investor capital. Today, the private credit industry is managing over $1.5 trillion and is expected to grow to over $2.3 trillion by 2027. Why such powerful tailwinds? For starters, private lenders have become one of the few games in town. When it comes to lending standards, banks have become extremely tight-fisted and require businesses to jump through numerous hoops. And yet, loans are a necessity for many successful businesses, most of which rely heavily on credit to fund operations. Credit can facilitate smooth cash flow management, fund and acquisition, finance and expansion, and much more. And while large public companies have no problem securing capital by selling bonds, private companies don't have that luxury. They borrow from private lenders. From an investor's point of view, private credit can have less interest rate risk. When interest rates rise, the prices of bonds fall. This dynamic doesn't always apply to private credit. This is because loans made to private companies usually have floating rates that adjust with market rates. So when interest rates rise, so do the payments made by the borrowing company, and thus higher cash flow to the investor. So how can one combine private equity, private credit, and other alternatives to reduce risk and enhance returns? Let's unpack it. Many believe that the traditional blend of 60% stocks and 40% bonds is dead, that we have entered a new paradigm, but where the addition of less correlated investments can enhance returns and lower risk. Famed investor Ray Dalio describes 12 to 15 uncorrelated investments as the holy grail of investing. Evidence would indicate that the world's largest investors share this sentiment. According to a recent survey, large institutions have between 34 and 59% of their portfolios in alternatives, while individual investors have just 5%. While the correct percentage of alternatives in each person's portfolio may vary, let's look at the impact offered by one long-term study. There has been extensive analysis of a 60-40 portfolio, 60% stocks and 40% bonds, and compare this to a portfolio with 50% stocks, 30% bonds, and 20% alternatives, made up of private equity, private credit, and real estate. Between 1989 and Q3 of 2023, the analysis showed that adding 30% alternatives resulted in an increase in performance, a reduction of volatility, and an increase in cash flow. What was the trade-off? This can reduce liquidity for a portion of the portfolio. Now, to be clear, not all private equity is created equal. Top decile managers have produced north of 25% compounded returns, while bottom decile managers delivered single-digit returns. This is where relationships and access become critical. The good news is that many of the largest allocators in the world are working to make life easier for individual investors and the advisors that represent them. Leveraging their purchasing power, advisors and their clients now have access to many managers that used to only accept institutional capital. For example, some closed and interval funds offer a fully diversified basket of alternatives, including private equity, private credit, venture capital, and real estate. These vehicles overcome many of the hurdles that investors previously faced. Investors can now enjoy periodic liquidity, the ability to invest qualified and non-qualified money, a simplified 1099 tax structure, and the ability to continuously add to their position. For qualified purchasers, those defined as having $5 million or more in investable assets, there are many more options to construct a portfolio of direct fund investments. These investors can take a more a la carte approach and choose to overweight or underweight certain segments, such as energy, infrastructure, and more. So whether it's private equity to enhance the risk-reward profile of a portfolio, or private credit to enhance investment income, we believe the inclusion of alternative investments is a critical piece of the financial planning puzzle. We invite you to learn more by visiting cazinvestments.com.